Give this 2 seconds. Hey guys, welcome to The Syndicate, the show where we get the world's best angels and VCs on the program. I have a terrible cold, so we're going to see what we can do. Today we got Daniel Gulatti on. He's at Comcast Ventures doing some pretty interesting stuff. Prior to that, founded a company, got acquired, and he's an all-around interesting guy. So thanks for coming today, Daniel.
Great to be here. Excited to chat with you.
How'd you find your way into the world of venture?
Yeah, so I guess my path is kind of a windy path. I don't really have a finance background or a VC background or a private equity background. I kind of come from the operating side. So I started my career at BCG, which is a consulting company, and at BCG kind of focused a lot on retail. So serving large retailers, and this was kind of 2006, 2007, at a time where, almost IT was kind of coming out of the back office and moving to the kind of forefront of those businesses. So, now we talk a lot about, all the stuff that's happening in e-commerce with Amazon and direct-to-consumer brands and that, but and with all the store closings that are happening now, e-commerce I think is like kind of a hot topic. But even back then, 12 years ago, I think retailers were already starting to think about the impact of technology on the customer-facing side of their business versus just kind of the back end of their businesses. So spent a lot of time working with those clients on just digital strategy, and kind of whet my appetite a little bit just on tech and just how exciting tech could be and how technology could fundamentally alter the cost structures of existing companies and sort of all the different disruption opportunities that tech kind of opens up. So I started there as an undergrad, as a university graduate, and then decided to kind of go down the MBA path. So went to Harvard to do my MBA in 2009, as someone that had a couple of years of experience under my belt, but not much more than that, and decided to start a tech company. So on, I think, pretty much the first week of school, met my co-founder, who was kind of spent a lot of time in the fashion industry, and we kind of got together and started a company called Fashion Stake, which is a marketplace for independent fashion designers, kind of trying to aggregate the long tail of designers, and raised venture capital and kind of ran that business for 4 years, and sold it to a company called Fab.com, which was at the time quite a large e-commerce company.
Quick jump in. Who was your partner? I feel like I've met them.
Who was my co-founder?
Yeah.
Yeah, a woman by the name of Vivian Wang.
Maybe I'm not sure. I swear
I don't know
someone.
whether you met her, but
Yeah.
Okay.
Somebody.
But sold the company to Fab and ran Fab's fashion business for the year, which at the time Fab was kind of known as this like design e-commerce company, and I think a lot of people thought about it as like a homewares company, but soft goods and within that apparel was like their best performing vertical. So I think Fab was definitely like a roller coaster. Like there were lots of ups and downs in that journey, but again, like that kind of solidified my appetite to kind of be in the tech world and try to make a difference in the tech world. And I think after that experience, took a little bit of time off and thought about where in the technology stack do I want to play? Do I want to play data? Do I want to play as a founder? Do I want to play as an investor? And just kind of concluded that investing was this really intriguing world where you get to meet all these really interesting entrepreneurs and work in different sectors. And I think that sort of generally appealed to my ADD-ness. And so I jumped over to Comcast Ventures as an EIR, actually, as an entrepreneur in residence, just because I had not fully decided whether or not I wanted to start another company versus be an investor. But after the first few pitch meetings that I went to as an EIR, kind of very quickly concluded that I wanted to be on this side of the table for the next phase in my career, and kind of have been there ever since. So I joined full time as a principal in July of 2015, and kind of have kind of stayed on since then, and focus a lot on the things that I was doing, the sectors that I was in as an entrepreneur, which is kind of e-commerce, marketplaces, and more broadly just consumer internet.
So EIR, it means something different at most organizations. What did it mean for you?
Yeah, so for me, it was really this landing spot where I could be very exploratory, right? So I think at Comcast Ventures, our EIRs have gone and taken operating roles. They've gone to found their own companies. They've got, one has gone to start, his own VC firm. And so I don't think we think about the role it's very situation dependent. So we don't think about it as a particular structured, type of situation. It's kind of what the individual wants to make of it. And so for me personally, what that meant was there's kind of a 50% start a company coming out of this role, and a 50% chance that I'll, be an investor. And I kind of didn't know that from the outset, and Comcast Ventures didn't really know how it would all play out. But during the course of the role, I think I kind of flipped over to the investing side. But I think, maybe this is different, versus kind of other funds, but I think we try to really tailor that role to the individual, just because I guess we find that works best. I think the quid pro quo is that you'll bring in some sort of deal flow. You'll bring the benefit of your network to the firm. But it's a very, it's a very exploratory relationship on both sides. So
is it a paid deal, or how does that work?
Yeah, it's a paid deal. Yeah. And I think actually these days, most EIR gigs tend to be paid. I know that wasn't always the case, but at least the EIRs that I know at other funds, it's a paid gig. So.
Well, let's jump back to Harvard. So you went there for an MBA. Would you do it again? Is it something where it was mainly the network, or do you feel like you learned something beyond that?
Yeah, I think definitely network value is kind of the top value bucket. I think that also for someone with my background, which I didn't have, I didn't come from some Ivy League school. I didn't, I grew up in quite a small town back in Australia. I didn't have the exposure that, my classmates who had gone to Harvard, Yale, Princeton, Duke, etc., had, right? So for me, it was the network value existed, and I think it was a little bit more valuable than maybe some others in the class. So I think that was number one. I think when I step back and think about HBS, I think there were two things that I really took out of it. One was this sense of self-confidence. And I think the idea of self-confidence is, you get up in a room and you speak with 90, you speak in front of 90 classmates, and you kind of really have to defend your point of view, because every class is kind of this case study class, right? It's not a one-to-many lecture broadcast where you have a professor standing at the top of the class and just lecturing. It's a very interactive situation, and so in every class you kind of have to be on, and you get graded based on the quality and quantity of your comments, right? So I think what the muscles that builds, like if you think about doing that every day for 2 years, multiple times, is you just become, because you have to, you just become very you become very data driven in the way that you comment, because you know that you got to back up your comments with something. And it also gives you that practice gives you the confidence of just being able to, go up in front of a big group of people and defend a point of view. So I think that was quite valuable for me. I think that's translated into other areas of the business world, like meeting people that are older, more senior, more accomplished, in the beginning of my career, coming out of school. I think that muscle was really kind of exercised, within HBS. And I think the second thing it teaches you, so confidence is one. I think the second thing it really gave me was this deep sense of humility, and specifically this idea that talent is really universal, when you think about it. So I think in my class, we had 93 folks in the section, and probably, 40 different, countries, 30 different countries, like a wide smattering of folks. And it just, one of the first things I remember from my business school experience was just, it just doesn't matter where you are. There are incredibly talented people everywhere in the world. And in many ways, that has kind of shaped my experience as an investor as well. This idea that you can kind of come to a place from the outside, maybe with a chip on your shoulder, maybe not, and really succeed in in Austin, whatever. But really this idea that the talent can come from anywhere, and it's kind of our job as investors to go and find the talent and nurture it and ultimately invest in it. So I would highly recommend, for me, for someone coming out of the kind of ecosystem, I think business school net was a great situation for me.
So it sounds like you're a big proponent of the wall. How did you get connected with Comcast Ventures? So you got an EIR gig, but everyone outside of venture is like, God, I want to get into venture capital, and everyone inside venture says something to the effect of, well, it just kind of happened, and one thing led to another, and I left my shoe in this guy's locker, and then this happened and that.
Yeah.
How did you get in touch with
I have another one of those like windy serendipitous stories, right? So I got connected to a guy by the name of Andrew Cleland, one of my partners here at Comcast Ventures, through a mutual investor friend that we had, a guy by the name of Owen Davis, who was at a fund at the time called NYCC. It was a kind of pioneer seed funds back there in New York. And we had first gotten connected. Actually, I think I'd pitched him on when I was raising money. And then I sort of reached back out to him, years later, and said, "Hey, I'm thinking about, the VC side of the fence." And he was very gracious. He made the introduction to Andrew, was very, kind of was on it straight away. Caught up with Andrew, and then, one thing led to another. So, I think for folks looking to break into VC, it's always a windy path. It's always this serendipitous path because of two reasons. One is there isn't this huge number of open roles, right? And so the supply of roles is far inferior to the kind of the demand for those roles. And so, that's one kind of dynamic. And the second dynamic is like actually chemistry really matters and fit really matters, because basically what you're doing as a VC is you're kind of linking arms with others in your firm and taking this plunge and making these investments together, and your kind of destiny in many ways, financial and otherwise, are kind of all intertwined, right? And so it's less about this machine that these consulting firms or banks or these big corporates where it's kind of it is very much a machine, and you're kind of this cog in this machine. It's much more of a cottage industry, and these firms are very small, right? So when you talk about a 5 or 10 person firm, like adding one person is a significant delta off the base of that firm in terms of headcount. And so, and one bad hire can really mess up the chemistry. So I think those are the reasons why I think it tends to be a pretty elongated and serendipitous path in for most folks. And I think what you want to be thinking about, at least what I thought about at the time, was, am I joining, I want to get in, obviously, but once I'm in, am I kind of joining a firm that if I hustle and work really hard and make some really good investments, do things kind of open up for me, right? And I think that's what folks need to be thinking about is, brand's important, and obviously working with an established firm, means something. But at the end of the day, you're really looking for the opportunity to kind of make investments and stick your neck out on things that may seem crazy or flat out wrong in the beginning, but kind of prove out over time, and have that in some way benefit you as an investor. So I think they're the dimensions on which I think about kind of getting into VC.
Plus, VC is very much a key man business or key woman. The person is bigger than often the brand, the firm, etc. Why?
Yeah, the other interesting thing about it is it's a very path dependent business, right? So it's one of these things where this might be a bit of an exaggeration, but it's kind of like, show me your first 5 deals, right? Like once you have access to a checkbook, once you're able to lead investments, it's kind of, your first few deals determine how easy or hard your life is going to be for 5 or so years, right? So, I think if I look around, the folks that have had some interesting investments in their first 5, I think tend to go on and try to, parlay that into a bigger, either, brand or position or a new sector that they might be exploring. And I think that story is a really positive, that momentum story. I think there are other folks where, you've been in VC for 5, 6, 7, 8 years, maybe you've written a couple checks, maybe those investments haven't really turned out. And I think just things become a lot more difficult. It's not to say that you can't recover from that, but I think, I think people should understand that, like, once you have that check writing responsibility, your skin is in the game, and your ass is on the line a little bit, right? And so I think you can make it easier on yourself by having 1 or 2 really good companies in your first 5 to 7, and kind of buy yourself the option to keep writing checks and do more and more. So
let's play devil's advocate and have a hard question. Do you know the book Thinking Fast and Slow?
Yeah, I do. It's a great book.
You know the law of small numbers?
What's that?
You know the law of small numbers?
Yes.
So for anyone who's not familiar, do you want to? I can summarize it, or do you want to summarize it? I think it's very relevant to what you were talking about. Uh-oh, did we freeze?
Yeah, sorry, you were breaking up.
What? Okay, so that's Putin's hacking my laptop. I have top secret information, guys. But anyways, so the law of small numbers. So basically, if you look at the cities, you look at the towns that have the highest rates of kidney failure, or the highest rates of anything, it's always going to be the small towns. And if you look at the towns that have the highest rate or the lowest rate of the same thing, it's going to be the small towns. And it's because when you don't have a large enough mass of statistics, it makes things seem relevant when they're really not. And my question, the devil's advocate deal, was how much of that is the VC top 5 deals, the first 5 deals, how much of it is just pure luck?
Yeah, and I think you'd be crazy to having done this for 4 and a bit years now, and looking around, I think you'd be crazy to conclude that luck isn't a factor in all of this stuff, right? I think on the entrepreneur side, for sure, and on the VC side, maybe even more so. And I think the way I think about it is, I think that the luck component is, obviously getting into these deals and being at the right place at the right time, and winning a deal over another firm and having an entrepreneur pick you, and a lot of things need to go right to just get in a deal that's really competitive. But I also think it's a luck component around how big some of these companies get. So I think it was Jeff Bezos that said, it was a really good quote from him, which I always remember, which is, in baseball, when you hit a home run, you kind of get four bases. In tech, when you hit a home run, you get, 10,000 bases. And just this idea of this massive power law that happens in tech and investing specifically. And so I think the luck component to me is, coming into an investment, you speak to a bunch of the early investors in a company like Snapchat or an Uber, like even those investors had no idea that the wins would be that gigantic, right? In a particular company, advertised in any particular company. And I think the human brain just isn't wired to think in exponential terms, right? So we're linear thinkers, right? We have this lizard brain. And so it's really hard for us to go into an investment that, the company that's worth next to nothing at a really early stage and think about how it could be the next Google or Facebook or Uber or whatever. And so I think the luck piece to me plays out just thinking through, I can go into a company thinking it's really good, and I can go into an opportunity thinking that it's really interesting, but having a market play out in a certain way that gives me 100x or even more leverage on my capital, I think a lot of that is luck, because I think a lot of these things are only predictable kind of looking back. But I think to your question about small numbers, like even with 20 investments, like the N is still kind of small at the end of the day. And if you're an entrepreneur, you've got an N of 1, right? There is no diversification. And so you have to believe that I think in VC you have to be a little bit of a mercenary. I think you have to believe a little bit that you are smarter than the herd, smarter than the crowd, right? And then I think you have to also have the benefit of luck. And I think a lot of investors have kind of come and gone that are really smart, that are really thoughtful, and just haven't had that X factor. So
makes sense. Yeah, it's a super interesting thought process, and it's like the concept, I don't know if you listen to Sam Harris's podcast, but it's like the concept of free will, where you can very much see how it doesn't necessarily exist, but you don't want to believe that because it so drastically affects your life and how you look at things that it's hard to accept the luck and to not think that there is more skill involved than there is. I'm not saying there's not. I'm playing devil's advocate to be a little bit fun, but it's something that people don't talk about enough, I think.
Yeah, I think also, just to put a finer point on that, I think there is some notion of access gets better as you build a track record, right? So I think that piece of the equation, I think, is pretty well defined, which is like, as you build your own brand and as you kind of have a few of your own kits in your portfolio, like you get better access. And I think better access increases the chances that you will get one of these outsized home runs. But I think that path, that kind of speaks to this path dependency piece, right? Which is like, you need to be quite lucky, I think, in your first few, and then once you have that, you can parlay that in a more systematic way to increase your probabilities over time.
So devil's advocate, what is your thoughts on indexing approach versus actual very hardcore traditional VC approach?
Sorry, you broke up then. Ask me the question again.
Yeah, sorry about the technical difficulties, guys. What are your thoughts on indexing versus startup specific investing?
Yeah. So I know you have a lot of angel investors listening and on the show. I think if you look at, from a perspective, certainly, if you look at the fund, I kind of went through this analysis myself. if you kind of look at what drives fund returns, and I've looked at this just from our fund perspective and also other funds, just speaking to LPs that I know, what really drives fund returns is outsized ownership. At the end of the day, what really makes a 10x fund a 10x fund is because you have outsized returns, outsized ownership in like one or two really successful companies. And I'm talking here about funds that are 100 to 200 million plus, right? So that end of the spectrum. So if you believe that outsized returns are kind of the biggest explaining variable, outsized fund ownership, outsized company ownership is the biggest explainer of fund returns, then you kind of work backwards from there and you say, well, how do I get outsized ownership? Well, that means I pretty much have to lead a round and most likely a relatively early round of investment in the company. And then, you kind of work backwards from there and you're like, well, how many boards can I sit on? Like, how many rounds can I lead? And the answer is a pretty fixed number, which is somewhere between 8 to 15 per investing partner, right? And so you kind of work backwards from what drives fund returns and kind of get to the answer of, well, you kind of need to be concentrated. It's really hard to drive outsized fund returns when you are when you're kind of adopting this peanut butter strategy, kind of spreading things out. That's at a fund level. I think at a smaller kind of micro fund, angel portfolio level, I think things are a little bit different because the hurdle, kind of the rate, the bar that you need to hit as an investor in terms of returning, $1 million or $500,000 that you put out, or $10 million micro fund. I think that if you kind of do the math, you can kind of get there on getting lucky on one seed investment in a portfolio of 20 or 30, right? If that investment does really well. So I think the answer to your question, I think the nuanced answer to your question is, the bigger the fund you are, I think the more, if you are going for outperformance, kind of tier one, top decile performance, I think you do need to have outsized ownership, and there are only a set number of dollars that you have in your fund, and so that necessitates a concentration strategy. I think if you're a smaller fund, a micro fund, angel investor, I think you can size returns by being a little bit more broad. So I think that's kind of the way to think about it. And I think also I think about this a lot in terms of sectors. So I get asked a lot, what are the interesting sectors and what's hot at the moment? Like what are you guys focused on? And I think there's like a couple thoughts that I always.
We're having slight technical difficulties. Can you hear me, Daniel?
Now index that. We're not buying some ETF, right? The idea is we want to pick the one company or two companies that really matter.
Hey, Daniel, you there?